Imagine a company we'll call Steady Corporation. It pays an annual dividend of $2 per share. When the stock is priced at $50, the dividend yield looks like this. $2 divided by $50 multiplied by 100 equals 4%. Now, let's say some bad news hits. Maybe earnings are down or there's a new competitor in the market. Investors get nervous and start selling, causing the stock price to drop to $25. Here's what happens to the yield. $2 divided by $25 multiplied by 100 equals 8%. Look at that. The yield doubled. But here's the disclosure. The company isn't paying you more money. The $2 dividend hasn't changed at all. The yield only looks higher because the stock price fell. This scenario illustrates a crucial lesson in dividend investing. A high dividend yield isn't an indicator to invest in that stock. In fact, it can be a warning sign sometimes. So, how do you separate the dividend stars from the dividend traps? That's exactly what we're going to explore in this video. We'll start by understanding basic terms like payout ratio, earnings per share, and dividend growth rate. We'll then use that knowledge to understand how to spot dividend stocks that can deliver maximum gains. And in the end, I'll give you 3 dividend powerhouses that tick all the right boxes. I'm Andrew, and welcome to the $1 Million YouTube channel. Let's start the video by understanding the key metric payout ratio. Payout ratio, simply put, is the percentage of a company's earnings that it pays out as dividends. Let's go back to our Steady Corp example to understand it better. Imagine that when the stock was at $50, the company's annual earnings were $4 per share. Remember, they were paying a $2 dividend. So their payout ratio would be $2 divided by $4 multiplied by 100 equals 50%. This means Steady Corp was paying out half of its earnings as dividends and reinvesting the other half back into the business. That's generally considered a healthy balance. But what if the stock price dropped to $25 because earnings fell to $2 per share and the company maintained its $2 dividend? Now the payout ratio would be $2 divided by $2 multiplied by 100 equals 100%. Steady Corp is now paying out all of its earnings as dividends, leaving nothing to reinvest in the business. This is unsustainable in the long run and often leads to a dividend cut. This is why it's crucial to understand what the payout ratio means. It is a powerful tool for separating those dividend stars from the dividend traps we mentioned. So, what's a good payout ratio? The lower the payout ratio, the more sustainable a dividend should be. A steadily increasing one could spell trouble. Let's now understand the term earnings per share or EPS. This metric is crucial because it forms the foundation of the payout ratio and gives us insight into a company's profitability. Don't worry, it's simple. Earnings per share is exactly what it sounds like. The company's profit divided by the number of outstanding shares. Imagine a company we'll call Growth Corp that has a net income of $1 billion and 500 million outstanding shares. Their EPS would be $1 billion divided by 500 million shares equals $2 per share. This means that for every share you own, Growth Corp earned $2 in profit over the past year. Here's the deal. Growing EPS often leads to growing dividends. If a company consistently increases its EPS, it has more room to raise its dividend without increasing the payout ratio. It's a quick way to gauge profitability. I'll expand more on how to use EPS to spot dividend stocks that can deliver maximum gains in the next section. But before that, let's quickly understand the metric that investors use all the time, price-to-earnings ratio, or PE ratio for short. For dividend investors, the PE ratio is particularly useful because it can help you avoid overpaying for dividend stocks. Remember, your total return comes from both dividends and potential stock price appreciation. Buying at a reasonable PE gives you a better chance at price appreciation. But don't worry if you've heard this term before and found it confusing. We're going to break it down step by step. The PE ratio is simply a way to compare a company's stock price to its earnings. Let's use our Growth Corp example again. Remember they had an EPS of $2. Now, let's say their stock is trading at $40 per share. Their PE ratio would be $40 divided by $2 equals 20. This means that for every $1 of earnings, investors are willing to pay $20. That's why you'll often hear people say a stock is trading at 20 times earnings or has a PE of 20. But what does this number actually tell us? Well, it's all about value and expectations. A higher PE might mean investors expect the company to grow quickly in the future. They're willing to pay more now for future growth. A lower PE might mean the company is undervalued, or that investors don't expect much future growth. The last term to understand before looking for a dividend stock is the annual dividend growth rate. It's the rate at which a company increases its dividend payments year over year. Say our friend Growth Corp paid a dividend of $1 per share last year, and this year they've raised it to $1.05 per share. The dividend growth rate would be $1.05 divided by $1 minus 1 is equal to 0.05 or 5%. This means Growth Corp has grown its dividend by 5% over the past year. But why is this so important? Well, businesses typically only raise dividends when they're confident about future earnings. It's often a sign of a healthy, growing company. If your dividends grow faster than inflation, your purchasing power increases over time. But be wary of unsustainably high growth rates. A company growing its dividend by 20% a year probably can't keep that up forever. Now that we've covered all these important terms, let's talk strategy. I'm going to show you exactly how I hunt for those dividend stocks that can potentially deliver maximum gains. Listen up, because this is where it all comes together. First things first, we're looking for stability and growth. So, here's what you need to do. Start by looking for companies with a solid track record. I'm talking about businesses that have been increasing their dividends year after year. If they've been doing it for 25 years or more, that's a great sign. Now, when you find a stock that catches your eye, here's your checklist. Look for a yield between 2% and 6%. If it's higher than that, be cautious. It could be too good to be true. Check the payout ratio. Don't just look at 1 year's payout ratio. Check the trend over the past 5 years. You want it under 60% for most companies. If it's higher, that's a red flag. Next, take a good look at their earnings. Are they growing consistently? If not, it's probably a no-go. If EPS is stagnant or declining, it could mean trouble for future dividend payments. Also, be aware that companies can manipulate EPS through share buybacks. By reducing the number of outstanding shares, EPS goes up even if total earnings haven't changed. That's why it's important to look at total net income as well. Then, compare the company's P/E ratio to others in the same industry. There's no universally good or bad P/E ratio. It depends on the industry and the overall market. But as a general rule of thumb, P/E below 15 is often considered potentially undervalued. P/E between 15 and 25 is pretty average. P/E above 25 might be considered expensive, unless the company is growing very quickly. If Growth Corp is in tech, and most tech companies have P/ES around 30, then Growth Corp's P/E of 20 might actually be quite attractive. If it's way higher, you might be overpaying. And finally, don't forget about dividend growth. You want to see it outpacing inflation. If it's not growing at least 5% a year, think twice. But here's the kicker. If dividends are growing way faster than earnings, that's a recipe for trouble down the road. Here's the secret sauce. Even if a stock looks good on paper, you need to understand the business. Is it in a growing industry? Does it have a competitive edge? If not, keep looking. We want the total package. A nice dividend that's going to grow over time, and a stock price that's likely to appreciate too. Let's now look into 3 stocks that have been chosen using the strategy. These are stocks that have treated me well, and I believe they've got the potential to deliver solid returns for years to come. First up, we've got a bit of a hidden gem, Cullen/Frost Bankers. This regional bank out of Texas has been quietly crushing it in the dividend game. They're yielding about 3.8% right now, which is pretty sweet. But here's the kicker. They've been hiking their dividend for over 29 years straight. Even through the 2008 financial crisis, they kept those dividends coming. That's the kind of reliability we're after. Next on our list is Microsoft. Now, I know their yield isn't super flashy at around 0.8%, but don't let that fool you. They are paying $3.32 per share. The payout ratio is crazy low, like 28.18%. You know what that means. Tons of room for dividend growth. And with their dominance in cloud computing, I think we'll be seeing those dividends climb for years to come. Last but definitely not least, we've got good old Procter & Gamble. Talk about a dividend champion. These guys have been raising their dividend for over 65 years. That's longer than I've been alive. They're yielding about 2.35%, and with all those household brands under their belt, I don't see demand for their products drying up anytime soon. Now remember, folks, these are just examples. I'm not telling you to go out and buy these stocks right this second. Always do your own homework before investing. If you're looking to invest in some of the safest dividend stocks, consider watching my video titled, The Best Monthly Dividend Stock 2024. I'll see you in there.